Hey, do you remember when we were younger and we used to go to a thing called a lock in, right? Where your parents would drop you off at, say, like Mega Skate all night long. You'd stay all night, you'd hang with your friends, and at the end of it all, you got on that payphone and you called them up and you said, hey, the lock in's over. It'd be like 7 in the morning on a, say, like a Saturday morning, and you would get picked up. Well, let's talk about the lock in as it refers to real estate. And are we seeing the end of the lock in, or are we going to buckle down for another year's worth of the same old thing?
Let me tell y'all something. Those people who bought those houses during COVID with those fixed interest rates of 3.0, 3.1, 3.2, some people got 2.9. You got people out here paying $900 for a mortgage. They ain't coming up off them houses, and I'm one of them. Baby, call me the wicked witch of the West. Baby, it's going to have to crumble down on top of me before I give it up.
So in real estate, the lock-in refers to what's going on right now is this trend that we're seeing where people have these lower interest rates that they got back in COVID times, or maybe, 2020, 2021, earlier than say 2023 when interest rates started ticking up. And they don't want to let go of those. So they're locked in, they're locking themselves in, and they're not selling their homes because they're looking at it going, well, if I sell my home, then I've got to go to another place and pay a higher interest rate and get the same amount of house that I'm going to get. So it's really creating a bottleneck in the real estate marketplace. So we're going to talk about that a little bit today. Now, to understand the bigger picture, we got to take a look at the mortgage rates history, right? So in 2020, of course, we had COVID and we had this long, drawn out economy sag. And so the Fed decided, hey, the best thing to do to stimulate the economy, let's lower the interest rate. And they took the interest rate, the prime interest rate, all the way down to like zero, which made mortgage rates somewhere around 3%. You might have got something even as low as 2.5%. Now, everybody's waiting now for those interest rates to come back. So we see a lot of buyers saying, well, when interest rates come down, what you need to understand about interest rates over the course of the last 100 years is that interest rates have been basically an average of 7%. Okay? The only other time in American history where we saw interest rates get as low as 3% is when, after World War II, the government intervened and lowered the cost of interest rates to 2.5 to 3%. So you're talking about the 1940s was the last time we saw interest rates like we just got through with in 2020. And what was it? Another big kind of catastrophe, another big crisis that we were kind of recovering from. And then over the course of those next 50 years, you saw interest rates go from, 3% all the way up to a high in the 80s, in the early 80s, of up to 18% interest to buy a house. So if you just take that timeline over the course of the entire, last 100 years, like I said, you're going to see that the interest rates have averaged somewhere around 7%. Now, why is that important? Why does that matter? You say, well, I don't care. I'm just waiting on this interest rates to come down because I'm not going to be a buyer until they do. Well, you may be making a mistake, okay? Because if you're waiting for interest rates to come back down to 2.5, 3%, you could be waiting, 80 years. That's the last time we saw them that low. So I remember when I bought my first house back in 2005. I think it was 2005. Yeah, it was. When I bought my first house in 2005, I got so excited because I locked my interest rate in at 5.875%. Okay. And nothing catastrophic happened to me because I got suckered on my interest rate. Like if you look at it from a perspective of the 2020 interest rates, 2021, you think, well, man, I would never pay that much. What an idiot. But the fact of the matter is I paid that much. I sold my house. I got out, made a little money, and moved on, right? Moved up, did the next thing. And so the important thing to me, from an investment standpoint, from a financial stability standpoint, owning that home is an important step that you should take. So once you own that home, then you start creating equity for yourself. You start creating wealth, financial freedom, those things that you're trying to get to, right? So if you're looking at it and you're going, well, I'm not so sure I want to pay that interest rate, don't focus so much on what the interest rate is, but more on what you can afford as a buyer, right? Now, if we take the average of that interest rate and we just look at what we can or can't afford, right, then you're going to have to look at a chart kind of like this one that I'm pulling up here. So this gives you an average payment, monthly payment on a $300,000 house based on the interest rate. So you can see that at a 3% interest rate, a $300,000 house is going to cost you like almost $1,300 a month. But if you go up to, say, a high of like 8%, you're going to be talking about $2,200 a month, almost $1,000 difference, right? But if you take the average, like I said, over the last 100 years, somewhere around 7% has been the average. So right now, we're somewhere close to 6% interest, 6.5% maybe. You're looking at a $300,000 house that's going to cost you somewhere around the neighborhood of $1,800. So right in the middle of those statistical averages, right? So if you're thinking about buying a house and then you go, well, what if the interest rate dips? All you have to do is refinance. Now, will it cost you some money to refinance? Absolutely it will. You'll have to pay closing costs. You'll have to pay some fees. So then you have to balance out whether or not you should pay those fees or just keep your interest rate and wait. If you're going to live there forever, if that's your forever home that you're moving to, then you might say, well, I'll go ahead and refinance this thing because I'm going to be here for the next 20, 30 years. But if you are thinking, I'm going to sell this house in 2 years, then refinancing may not make any sense for you, right? So as we kind of look at the chart, you can see there what that difference makes. So like at 3%, your monthly payment is $1,265. At 7%, your monthly payment is going to be $1,996. That's over $700 a month compared to 3%. But again, those super low interest rates are not going to be that common like we felt like they were. And just remember this, that when we had those super low interest rates, the other thing that was happening is, just like the Fed knows how that works, super high inflation, right? So when we had that low interest rate and there were so many buyers, then sellers could just charge what they wanted to, right? And you saw that a lot. I dealt with that a lot during the pandemic and shortly thereafter, where people were out there just going to the house, making an offer on the phone from the house, $10,000, $15,000 over asking price, whatever we have to pay, we want to get it. And then sellers realized, hey, I can charge more, I can charge more, I can charge more. And so the lowering of the interest rate stabilized the house prices to a certain degree. And now what we've said, the raising of the interest rate stabilized the house prices to a certain degree. And now what we're seeing is, once you get to a certain point, then that slows the market down too much. And that's the Fed's job, right? To balance the interest rate and the prices that we're seeing. So if you raise the cost of money, then you should lower the cost of goods or slow down the raising of the cost of goods. And the housing market speaks volumes to that. Now, one thing we're seeing that kind of bucks that trend is the new construction, because there's such a vacuum where we need more new houses being built. So new houses are selling through because nobody has to sell their low interest rate to get out of that, right? They're still staying in there. So what should buyers and sellers do? For buyers, don't let the higher rates scare you off. Focus on what you can afford. Remember, you can always refinance on the drop in the future. Think about working with a lender who can explore creative options for you. Now, for sellers, if you're thinking about selling, the lock-in effect could really work within your favor because there's so few homes on the market. A well-priced property will attract the buyers that are in the market. And the other segment of the real estate market, investors, higher borrowing costs obviously means the deals don't work as good as they used to as far as cash flow. So what do you have to do? You have to look for other opportunities where maybe you can add some value. Maybe you can do a little work yourself, or do a little fix up that first time home buyers are not willing to or able to have the financial means to do it. Maybe you can do that, and that's where you add your value, because you can force the appreciation on the house. So the lock-in effect and interest rates are shaping the real estate market, but the big thing is real estate is always going to be fluid. It's always going to be moving. So don't forget to like this video, subscribe to the channel for more real estate insights. Leave a comment below. What's your biggest challenge in today's real estate market? I'd love to hear from you. Thanks so much. Have a great weekend. See you soon.